Good evening, friends. As my earlier speakers have said, the past 2 or 3 years have really been very, very difficult years for charitable trust. Possibly the Finance Act 2024 was the only provision or the only year in which the lawmakers gave us a little bit of relief. Today, the computation of income of charitable trusts and the filing of the return remains a great challenge. The IMC and the BCS thought it fit to bring to you a seminar covering both aspects. And while the computation is undoubtedly important, equally important is a proper filing of the return. The reason being that the said return is going to be processed by way of artificial intelligence. And in all our offices, there are a spate of intimations where trusts are facing demands, mostly erroneous. Some of these demands possibly could have been avoided by a more precise filing of the income tax return. And one of the deadlines in compliance is very near, in as much as 31st of August in itself, you will have to comply with filing of Form 9A and Form 10. Then you have 30th September, the audit report, and 31st October is the normal filing deadline for returns. Today, to deal with the subject, we have two stalwart speakers. Mr. Gautam Nayak is a past president of the society, is a or has been the editor of our Hallowed Journal, has been a speaker at a number of programs, seminars all across the country. He has written a number of papers, and to his credit is a continuous 28-year contribution to the BCS journal on controversies. The only controversy that does not remain is his ability to deal with charitable trusts. He's a very close friend, and I fondly call him the lender of the last resort. If there is any difficulty in tax, he is the person whom we turn to. Mr. Ashok Mehta is also an eminent professional, has been dealing with charitable trusts for a long period. He has been a speaker at a number of programs on charitable trusts, including those organized by the Bombay Chartered Accountants Society. He will walk us through the ITR 7, its formalities, its compliances, etc. And at the end, we will have a question-answer session. So we will not have a break in between. Time is running out. And so therefore, I would straight away request Gautam to take up the computation of income and take us further.
Thank you, Anil, for the kind words of introduction. And well, I believe that is more because of our friendship. I think, Anil has those kind words to say about me. So far as when he talked about the controversy and, that there is no controversy that I can deal with charitable trusts. Frankly speaking, I think in the last 1 or 2 years, I have, started having doubts that, is this the correct way, the law is this the correct, I think the way the law is being dealt with, the way the law amendments are coming, it is making a law which was already complex, far, far more complex. And further to that, I think the return is something which baffles me completely. And therefore, thankfully, I'm not dealing with filing of the returns. Fortunately, in my office, there are very competent professional assistants who handle that and who are much more savvy and figure out a way to fill up the return correctly so that there is no problem. Because today, the way electronically the returns are processed, one small mistake can result in a huge demand. And, doing an appeal is, of course, an expensive proposition. You've got to deposit 20% of the tax, etc. So those are the problems. So what I would like to do is, therefore, give more time to my co-speaker, Ashok, so that he's able to deal with the various aspects of the return. I will quickly take you through the various aspects of the filing of the return is or the computation of income on that part of it. So what you need to remember is that this is a computation of an exemption. So when will be dealing only with sections 11 and 12, I would not want to take 1023C because that itself will take a substantial amount of time. So given this time of 40-45 minutes, what I would try to do is deal with the computation of the exemption under section 11 and 12. So here, what you have to remember is that this is an exemption provision and it is not a computation of an income under the different heads of income. So there is this concept of commercial income, etc. So you have to determine the income in the first place. Then what you are allowed an exemption out of that income is the amount of income applied for charitable or religious purposes in India is under section 11(1)(a). There are other provisions of 11(1)(c), etc. But let's focus on 11(1)(a), which is for 99.9% of the trust, which is the provision applicable. Up to 15% of income can be reduced by way of accumulation under section 11(1)(a). In case there is some income still remaining, you will opt to spend the income in subsequent year under the expression 1 to section 11(1), or you can opt to accumulate that income for a period of 5 years under section 11(2). Then what you're supposed to do is you look at, are you carrying on business? Then if you're carrying on business, does 11(4)(a) apply? Have you fulfilled the requirements of section 11(4)(a)? Does the proviso to 215 apply in your case? So that's what you have to look at. And therefore, do you lose the benefit of exemption under either of these? Then is there something which becomes taxable under section 11(1)(b) for where you have exercised the option in the earlier year and not spent it, etc.? Does that get attracted? Look at, is there taxability? If you had an accumulation under 11(2) for a period of 5 years and that 5 years is over, you not spent it, or you spend the money for something else, the question is it taxable in that year? That's something which whether you need to add that to your income. And then you check the applicability of 13(1)(c) and 13(1)(d) if there's a benefit provided to a specified person or the investment pattern is not followed. So now let's look at each of these components in a little more detail. So when it comes to income, the concept is you calculate you have to take the income in a commercial manner. So you have that old CBDT circular of 1969, which says that the commercial concept of income is to be done. And commercial computation is not as per the heads of income, but as per the books of account. And that circular goes on to say whether trust, derived income from house property, interest on securities, capital gains, or other sources. The word income should be understood in commercial sense, that is book income, after adding back any appropriation or application thereof towards the purpose of the trust or otherwise, and also after adding back any debits made for capital expenditure incurred for the purpose of the trust or otherwise. So therefore, you look at your income as per the income and expenditure account. So whatever is the method of accounting that you're following in your books of account, if you're following accrual, the income will be taken as per accrual method. If you're following the cash system of accounting, the income will be taken as per the cash system. So that is the way you would look at it. Voluntary contribution, section 224(2)(a) says voluntary contributions received by trust created wholly or partly for charitable or religious purpose is regarded as income, because earlier there were decisions saying that this is a capital receipt, etc. There were a High Court decision. Subsequently, the law is now clear. It is income, voluntary contribution, and section 12(1) says that this is income from property held under trust. What is entitled to the exemption is income from property held under trust, and donations are also deemed to be income from property held under trust. So that is part of income. Now the question we are very often, which I'm very often come across is, when a trust incurs administrative expenses, is that to be reduced from the income, or is it an application of income and to be treated as exempt by virtue of the application of income? Now, your administrative expenses could be of two types. One is an expenditure incurred for earning an income. Say, for instance, if you are earning a rental income, and for earning that rental income, you pay certain municipal taxes, or you pay some collection charges, etc. Now, therefore, those are expenses incurred for earning the income. And the commercial concept of income would mean that you necessarily have to deduct those expenses from your income to arrive at what is the income for the purpose of computation under this provision. So far as depreciation is concerned also, now depreciation, there is a specific provision which says that if you have claimed the capital expenditure on objects as an application of income, then you will not get depreciation. But earlier, the concept was that depreciation was allowable to you irrespective of whether you claim it as an application of income or not, on the ground that depreciation is a necessary outgoing in computing what is your commercial income. So therefore, the depreciation was to be reduced from your commercial concept of income. Now here also, what you'll have to do is look at what is the depreciation composed of. To the extent that it consists of assets which are been claimed as the addition of those assets has been claimed as the cost of those assets has been claimed as an application of income for charitable purposes, then that depreciation is not to be taken into account at all. But depreciation on other assets which has not been claimed as an application of income for charitable purposes, that depreciation will stand to be reduced from your income. Now, what about income tax? So this is a question which I think people very often don't realize, that so far as income tax is concerned, say today there may have been tax liability and you had to pay off the tax liability, or there may be TDS deducted from your income. Now, the question is, you are required to spend 85% of your income. If you have paid taxes, if you paid this TDS has been deducted, that income is not available to you. How can you spend 85% of that? It is on that logic that the tribunals and courts have taken a view that income tax is also, which you have paid, has to be deducted from your income, because you cannot spend 85% of that, and that's where it is allowable as a deduction. So under normal provisions, as you know, income tax is not a allowable deduction, but for charitable trust calculating the exemption, income tax is something which is allowable as a deduction. So that's something which you need to keep in mind. And of course, the question is, what happens when you get an income tax refund? And there have been some case laws where they said that no, it is not income when you get a refund. But I think the safer position here is that you offer it to tax the refund, because then it is available for spending, and therefore commercially, yes, that's something, income tax refund, you would reflect it in your income and expenditure account. And therefore, I would feel that it's better that you offer it, you include it in your income when you get the income tax refund. Then there is this concept of corpus donations. Now, as you know, donations could be of two kinds. One is the regular donations which you receive and which go into your income and expenditure account. The second is donations which you receive for a particular capital purpose. What is the meaning of corpus? Corpus means capital. So if you receive a donation, say for a building fund, now that is a corpus donation, but there are conditions of course, the question is whether this is income at all. Earlier, Section 224, 280, Assessment Year 8990 had the provision which says voluntary contributions not being donations, not being contributions towards the corpus. Those words not being contributions towards corpus were deleted from Assessment Year 8990, and you have a specific exemption provided in the Section 11(1)(d). While there is a strong legal view that corpus donations are not income at all, the income tax department clearly has been saying that no, corpus donations are income, and you have to fulfill the conditions of Section 11(1)(d) if you want to claim exemption for corpus donations. Now, earlier the language of that was only if it was to the extent if it is specified by the donor, and that was the requirement. So therefore, if you had a letter in writing from the donor confirming that it is towards the corpus, then in that sense it would be, you could claim it as exempt. Now you have an amendment which came in last year, which said that it is subject to investment in specified modes under Section 11(5), and therefore what you will need to do is, so whatever is the corpus donation which you have credited to specified funds, you will have to see what is the incremental corpus during the year. So suppose if your corpus was 1 crore as of the end of last year, as of March 23, it has gone up to 1 crore 15 lakh as of March 24. Against that, you see what were the corpus investments which were there as of March 23. Have those corpus investments gone up by 15 lakhs during the year or not? If they've gone up by 15 lakhs, you can claim exemption for the full 15 lakhs. If the corpus investments have gone up by only 10 lakhs, then only 10 lakhs would be exempt. 5 lakhs would be subject to tax. That is the position now, is the position. So therefore, you look at the movement in the corpus, you've got to look at the movement in the corpus investments. And what is important is that you have to, when you're finalizing the balance sheet, please keep this in mind, that the corpus investments have to be earmarked for that particular corpus fund. So that is something which is important. So that is so your exemption for corpus, you will have to include it. In fact, the return form specifically requires you to show the total of donations received, and out of that, how many are corpus donations, etc. So therefore, this is that, yes, you will get, it is income, but you claim it as an exemption under 11(1)(d) if you fulfill the conditions. And, of course, when you look at the audit reports, etc., the movement in the corpus is required to be shown, the movement of the corpus investments is required to be shown, etc. So that is the, if you receive capital assets in kind, then I think, one would treat it, immovable property is, because under 11(5) it is an approved investment. So therefore, that would clearly, if you receive an immovable property as a donation, that would be a corpus donation, it would be entitled to exemption. But if you receive other assets, then I think it's advisable that you treat it as regular donations and you show them as applied for the charity objects of the trust. So it's like a contra entry effectively at the part of the income as well as an application of income is the, because if for instance an ambulance or a medical equipment or in the case of a temple jewelry for the deity, etc. So in those cases, it's advisable to show it as an income as well as an application of income in those cases. Now, when it comes to application of income, which is entitled to the exemption, now there is an amendment which came in last year, which said that, which came from assessment 22-23, sorry. It says that the application of income is to be considered only on an actual payment basis, irrespective of the method of accounting. So what you will now need to do is, whatever your expenses, normally what one does is prepares a reconciliation. What was your opening outstanding expenditure as of last year? What is the expenditure debited to the income and expenditure account during the year? And this will apply, of course, only when you're following mercantile system of accounting. It will not apply when you're following cash system, because cash system, what you debit is actually paid out. So you will have a reconciliation in your following mercantile. What is your opening outstanding? Against that, what is the amount debited to the income and expenditure account during the year? And what is the closing outstanding? And therefore, the opening outstanding, plus the amount debited to the income and expenditure, less the closing outstanding is what you will be, is actually paid out during the year. And that is what will be allowed to you as an application of income. Now, it is well settled that even if you have incurred capital expenditure on your objects, that is also allowed to you as an application of income. But here also, to the extent that you're paid for that capital asset, only will be allowed to you. So if you have a liability towards the capital asset, say you bought a capital asset and you paid 80% of the value of that capital asset, then only 80% will be. Conversely, if you paid an advance for acquisition of a capital asset, then you would still be able to claim it as an application of income, so long as you ultimately acquired the capital asset in the subsequent year. There are a few things that you need to remember so far as donations to other trusts are concerned. Corpus, if you made a corpus donation to another trust, that corpus donation will not be allowed to you as a deduction at all, because that trust is entitled to the benefit of exemption. And there's a specific provision now which says that a corpus donation to another trust which is registered under section 12A or approved under 1023C, that will not be allowed to you as an application of income. Now, of course, what about if you have a trust which is not approved under those 4 clauses of 1023, but it's a small school, for instance, whose gross receipts are less than 5 crore and therefore is not required to seek approval. Now, that will not be covered by this prohibition of corpus donation being allowed. So therefore, you look at, is that trust registered under 12B or is it approved under clauses 4, 5, 6 or 6A of 1023C? It's only those corpus donations which are to be disallowed. Then if it is not a corpus donation, but if it's a general donation given to the other trust, then only 85% of such other donations to other trusts are to be allowed as a deduction. And this is an amendment which is coming from assessment year 24-25. So therefore, this is something which you now need to be aware of. In particular, let me spend 2-3 minutes on this aspect. So question is that how does one compute, and why 85%? And so the logic for this 85% was, they said that trusts were receiving donations. They were giving 85%, maybe 15% accumulation, 85% they were donating to another trust. That trust in turn was retaining 15% of 85 and passing on the balance to another trust. That other trust would retain 15% and pass on the balance. And nobody was spending at all on this for charitable purposes. It was just a round circle of donations which was happening between related trusts. And they found some 3 or 4 such instances, and therefore they said that, okay, no, only 85% of donations to other trusts will be allowed as an application of income. Now the question is, you're donating 100, you're getting 85% as an application. Can you claim the 15% as an accumulation of income? Now, accumulation means that that money is normally available to you, and therefore there was a doubt whether that 15% would be available to you or not. And that fortunately the CBDT in its circular of 3 of 2024 dated 6 March 24 has clarified that 15% of such donation by the donor trust is not required to be invested in the specified mode under 11.5, as the entire amount of 100 has been donated to the other trust and is accordingly eligible for exemption. So therefore, if you donate 100, you will get 85 as an application of income and 15% as a permissible accumulation under section 11(1)(a). So that is something which is clear. But what you need to remember is now you will have to donate 100 to get the exemption and not only 85. Earlier, you could donate 85 and get exemption. Now you have to donate 100 to get the exemption. The entire amount would have to be given. And just let's look at 3 or 4 situations and how this competition would work. Let's assume to take a first situation where income is 1,000 rupees. You donated to other trusts 1,000 rupees. Now, 85% of donations would be allowed to you as an application of income. You are allowed an accumulation of 15% of income, which is 150 of 1,000, which is your income. And therefore, you will get a total exemption of 1,000 rupees. Second situation is you got 1,000 rupees, you donated 600 to other trusts, and you spent 400 on your other objects, actually directly on your objects. Now, 85% of 600 will be allowed to you as an application of income, which is 510. Your 400 rupees, which you spend directly on your objects, will also be allowed to you as an application of income. Therefore, that will be further, you are entitled to the balance amount of 15% of the income of the trust, which is 150, subject to the remaining income, which is 90 rupees. So 510, 400 plus 90, which gives you a total exemption of 1,000. So therefore, it is fully exempt. Take a third situation where your income is 1,000, you donated 600 to other trusts, but directly on your objects, you spend only 250. Now, again, 85% of 600, which is the donations, you will get 510. Whatever you spend, actually 250 you will get as a donation, as an application of income. And so, which is 760. Now, 15% of 1,000 is also you're allowed as an application of income. So, another 150. So, 910 is your exemption. Though you have given away, so what have you spent? You spent 600 plus 250 is your actual spending, 850. But you will get exemption for 910, though you're accumulating 15%. Your taxable income will then be 90. Now take the fourth situation where your income is 1,000 and you've donated 850 to another trust and you not spend anything directly on the objects. Now 85% of the donations of 850 will be allowed to you as an application of income, which is 723. You have no other expenditure on objects. 15% of your income you can accumulate. So 723 plus 150, 873 is your accumulation. And your taxable income would then be 127 in this situation. Until last year, if you donated 850 and you had an income 1,000, you would have got 850 as an application of income. You would have got 150 as accumulation of 15%. And therefore, the entire 1,000 would have been exempt till last year. But from this year onwards, from assessment year 24-25 onwards, what you need to remember is that what will be taxable, you will have a taxable income of 127 in this situation because you've only donated 850. You can't accumulate 15%, in that sense of without, because 15% of this has to be within your total accumulation limit of 150. So that's the way this would work. Now, in calculation your application of income, also if you spend anything out of your corpus or out of loans, then it is not to be treated as an application in the year of spending. But in the year in which it is reinvested or repaid, it is to be that there's a time limit of 5 years. But that 5 years has started from last year, and therefore it we've still not reached that period of 5 years. But the question is, if you you've withdrawn a corpus investment, spent it for a particular purpose. Now, this year last year you have withdrawn from the corpus and spent it. Last year it was not allowed to you as an application of income. This year, when you reinvest that much money, it will be treated as an application of income, is the way it would have to be treated. Similarly, in the case of a loan, if it is a repayment of a loan in this year, to that extent of principal amount, that would be treated as an application of income in this year. Then the other adjustment is if TDS has not been deducted, where TDS was deductible, 30% would not be treated as an application of income. Just like when you're calculating business income, the same way, 30% of the expenditure is not to be considered as an application. But in the year in which TDS is deducted, that 30% will be allowed as an application. Cash payments exceeding 10,000, Again, there also, it will not be treated as an application of income. The provision of 40A3 are applicable here as well, just as in computation of business income. So that is the deficit of earlier years. What was happening is a number of high courts and even the Supreme Court had taken a view that if you had a deficit in a particular year, in the subsequent year, that deficit could be reduced from the income of the next year. And then that would give you a real commercial income, and you have to spend then 85% of that income. That was the view which was being taken. Now, the law last year was amended. From last year onwards, the law has been amended. You can no longer claim that deficit of any year. In fact, you're now required to show out of from where you spend that deficit. Is it out of your early years accumulation? Is it out of corpus? Is it out of borrowing? Is it out of the 15%? Or what is it out of? That's where you'll have to show that, that ex surplus thing. And therefore, it is no longer allowable today, a deficit. You can never have a charitable trust claiming a deficit in that sense. The deficit effectively could be, because also spending of corpus or loans, you're effectively getting the benefit of carry forward in the year in which you recoup the corpus or you repay the loan in that year, you're getting that as a deduction. So in that sense, that is the reason. And then there is another thing, and on this application of income for purposes outside India is one thing which under 11(1)(c), only application for purposes outside India is allowable if it is with the prior approval of the CBDT and for purposes for welfare in which India is interested. Now, there has been some debate between the courts. There have been conflicting decisions of courts, while the Delhi High Court has said that application of income means where the income is spent. So if you remitted money abroad, then therefore for the purpose of for purposes outside for your charitable purposes, and you've not taken the approval of the CBDT, then it's not allowable to you as an application of income, is what the Delhi High Court has taken a view. The contrary view has been taken by the Karnataka High Court. Karnataka High Court has taken a view that what matters is where the purpose is. So if your purpose is in India and you spend the money abroad, but it is for charities, charitable purpose in India, then it will be treated. So the question is whether it's application outside India or the purpose outside India. And there's a debate, and therefore, in most cases, I think most charitable organizations are following the Karnataka High Court view. They are following the view that it is the purpose which has to be in India, and that is not the purpose outside India. That's the way. So that is so far as the application of income is concerned. Coming to the exemption for capital gains, under section 11(1) capital A, if you reinvest your capital gains in a capital asset over and above the cost of the original asset, this is to be treated as an application of income. Now, your capital gains is to be computed irrespective of whether the asset is long-term or short-term. It doesn't matter. There's no concept of indexation or anything. It is gains as per the books of account, not as computed under the head capital gains. The reinvestment can be in any permissible capital asset, not only in specified bonds. There is no time limit for within which such investment has to be made. It's not within 6 months or anything like that, but it should be within the same financial year. So by the end of the year, the balance sheet, it should appear that this has been reinvested in the capital asset. What happens is that the reinvestment is to be adjusted towards the original cost of the original asset which was transferred, and then the gain. So therefore, first, only over and above the original cost, what you invest is allowable effectively as an exemption that is there. There is no minimum period of holding. You should hold it till the end of the year. You can't say that I've acquired an asset within 15 days and I've disposed of it after 2 months, and at the end of the year, it's not held. I think that's a problematic situation. Ideally, you should hold it at the end of the year so that there is no dispute that you've reinvested the capital gains. Of course, there have been case laws which say that even a fixed deposit for 30 days is sufficient. A fixed deposit with a scheduled bank, you invested on 15th of March and maturity is on 15th of April. That should be good enough. There's a CBDT circular which says that 6 months fixed deposit, but the courts have taken a view that even 30 days or 60 days should suffice. What if you've not invested in a capital asset within the same year? There is a Calcutta High Court decision in the case of East India Charitable Trust where they said that in that case, you can exercise the option under explanation 1(2) to section 11(1) to reinvest. Because when you reinvest in the next financial year, it is regarded as if you have applied that income for charitable purposes. So therefore, you can use the explanation 1(2) to section 11(1) by filing the form number 98. So that is something which is permissible. Then coming to this 15% accumulation under 11(1)(a), there is no time limit required. It's of your income. As I said, what is the income? We discussed that. There is no time limit. There is no forms required to be filed for this 15%. There's no entry which is required to be made in the books of accounts. This 15% accumulation of income cannot result in a deficit, as I said. It is an accumulation of the income, so income which is left over after applying for charitable purposes, and therefore it cannot result in a deficit. The question is of gross income or net income, as we discussed. Administrative expenses which are incurred for earning the income would have to be deducted. The depreciation which you're claiming, which you're eligible for, will have to be deducted. Income tax, etc., would have to be deducted. So that's the question then is, what about corpus donation? Can I claim 15% accumulation on the corpus donations? And to my mind, I think corpus donation, you're already claiming 100% exemption under 11(1)(d). To the extent that corpus donations are taxable because of the fact that you've not invested them or you don't have a letter from the donor, there you can claim 15%. But otherwise, if it is exempt 100% under 11(1)(d), then further 15% accumulation will not, I think, will not be justified. What about the capital gains which is claimed exempt under 11(1)(a)? Again, there is the entire capital gain is claimed as exempt under 11(1)(a). Then again, whether that 15% will be eligible or not. And one of the points which I may just mention is for the capital gains, you have an option. You can either spend it for charitable purpose, so 85% of that you can spend for charitable purpose, or you can reinvest it into a capital asset and claim exemption. So either cases you'll be allowed an exemption. But if your capital gains is fully exempted under 11(1)(a), then the question is, can I still claim? I think it is debatable in this situation, but because capital gain is in a sense a form of income. But I think to be on the safer side, maybe one should look at it that can I still get the full exemption without claiming exemption so far as 15% of capital gains is concerned, and that may be the safer position to take. Then in subsequent years, if I'm spending something which is out of such 15% accumulation, the question is, should I really get this as, would this be, how is the treatment there? And there, I think there is no treatment, unlike corpus or loans, etc., where it doesn't matter. But that in that year, say, let me put it this way, you have an income of 100, you spend 120, and the 20 is out of the surplus which you have accumulated over the earlier 10, 15 years. Now, the deficit in any case is no longer eligible. So what you will get is what is spent out of income for the year, applied for income is only 100, and therefore that will be the exemption that you would be entitled to. Now, coming to the option to spend in the subsequent year under the expression 1.2 to section 11.1, where you have to file that form 9A. So if your application falls short of 85%, now there could be two reasons why you could exercise this option. One is that if certain income is not received during the year or for any other reason, you can opt to spend such income not received in the year of receipt of income or such shortfall in the subsequent year. So if that you have a situation where your income is not received during the year, you can opt to spend that in the year of receipt of income or in the subsequent year following the year of receipt of income also. But if it is on account of any other reason, that shortfall has to be spent in the subsequent year alone and not in the year following that. So that is one distinction you need to keep in mind. So that option is good. The form 9A is to be filed. The form requires, in case of any other reason, to give reason for shortfall. And can inability to spend in time be a reason? I think, yes, you can take that because there is no this thing that all you have to say is, what is the reason? The reason was I could not spend it. That's it. I mean, that could be good enough. If you file your form 9A late, there's a CBDT circular saying that you can make an application for condonation of delay up to 3 years to the principal commissioner or chief commissioner, principal chief commissioner or chief commissioner. Now, when you receive the income or in where if it is, you opted to spend in the subsequent year, that amount of option is to be reduced from the application of income of that year. You don't have to do a 1:1 matching. So that is like 11.2, which you have to give the reasons and it has to be spent only for those reasons. It's not like this in this case. In this case, all you can do is whatever is your application of income, reduce this amount which you had opted to spend in the subsequent year, you reduce it from that application of the subsequent year. Now, 11.1b says that if it is not spent in that year of receipt or the subsequent year, then it will be taxable in the following year. If your option was for any other reason and you've not spent it in that subsequent year, then it will be taxable in that subsequent year. So there is a distinction for if, say, let me put it, give you an example. Say, if, for instance, I have a cumulative fixed deposit. I have not received income of 100 this year. I opt to spend it in the subsequent year. Now, in which the fixed deposit go to, in the year of receipt of that income, say, for instance, that fixed deposit matures in the next year itself. Now I have to spend that 100 rupees either in that year in which the income is received or the following year. So I get effectively 2 years to spend that, assuming that it was due, the income is received in the subsequent year. So that is, but if it is for any other reason, then it is only in the subsequent year that I have to spend it. If I don't spend it in that subsequent year, then it will be taxable in that year. So that's the distinction which you need to keep in mind under 11(1)(b). Accumulation of income under 11(2), where there is a shortfall, the balance is to be set aside or accumulated for a period of 5 years. You have to file form number 10 before due date of furnishing of return. You have to mention the purpose of accumulation and period of accumulation in the form. You can mention multiple purposes. Now, there is a controversy as to whether reproduction of general objects is sufficient or not, whether you can just make a reference objects. I would suggest that you can have multiple reasons, but multiple purposes, but don't mention just the general object. Don't say for education or for medical relief. You say for setting up a hospital, for purchase of an ambulance, for funding major surgeries of poor patients, etc., etc. You can give 20 reasons, but give those specific purposes. Don't give a general thing like medical relief or education, or just refer to as per objects of the trust. Don't say that, because that will lead you into controversy. So that is one thing which you have to keep in mind. You have to, of course, the accumulation has to be invested in specified investments. That is, copy of resolution is not required to be enclosed with the form, but at the time of assessment, sometimes they do ask you, and what if the purpose is not mentioned in the form, but in the resolution, there is a Supreme Court decision which says that that should suffice. But I think it's always advisable that you mention in the form as well that what is the purpose of accumulation. The form requires you to set out the amount of accumulation against each purpose, and that is not in accordance with the section, according to me. And so ideally, what one should do is try and fit in all those purposes within one box and put the full amount over there against that, so that you don't have to give again for each purpose what is the this thing, etc. That's the simple way to do it. The amount of accumulation in 11(2), you cannot utilize it by donating it to another trust which is approved under these clauses of 1020C or which is registered under 12AB. And if you're not able to spend it within this period of 5 years, you can change the purpose of accumulation before that, but requires the approval of the assessing officer. You cannot extend it further beyond 5 years, but within that period of 5 years, you can choose to change the purpose and by taking the approval of the assessing officer. So that is so if that amount is applied for other than specified charitable or religious purpose, or ceasing to be accumulated, or which is not invested, or it's not acquired within the period of 5 years, it becomes taxable in that relevant year. Now, that period of 5 years earlier, it became taxable. You could spend it within 5 years or the following year. Now, the law is that it becomes taxable in the 5th year itself and not the 6th year. That is the position. The unspent amount will be taxable at a flat rate of 30% plus applicable surcharge and cess under Section 115 BPI. So there is no set off of deficit of a relevant year which is allowable against that. So the amount of accumulation, if the trust is being dissolved, then yes, you are allowed to donate it to another trust. Normally, as I said, you cannot donate it to another trust but there's a specific provision saying that if you donate it to, that is permitted if the trust is being dissolved. Under that situation, it is permitted. Anonymous donations are not entitled to the benefit of exemption to a certain extent. Yes, over and above 1 lakh or 5% of total donations, the higher of that, exceeding that, that is taxable at a flat rate of 30% plus applicable surcharges. Now, what is anonymous donation? What is the meaning of anonymous donation? If the name, address, and other prescribed particulars are not maintained. So does it mean that you have the PAN also? No, PAN is not required. What is required is the name and address. So this is so if the name and address is there, but PAN is not there, it cannot be treated as an anonymous donation. That is, I think, very clear. This anonymous donation taxability applies only to trusts which are charitable trusts or religious and charitable trusts where a donation is received for educational or medical institution. So charitable trusts, in any case, all anonymous donations taxable in excess of these limits. But a religious and charitable trust, it's only if the donation is received for education or medical institution over these limits, then only it is chargeable to tax at this flat rate of tax. If there's a benefit given to specified person, then to the extent of the benefit provided, and the specified persons typically is the settler or a trustee or a substantial donor. And substantial donor, as you know, is where you take the aggregate donations exceeding 50,000 since the inception of the trust. That is the this. And so what about, very often a question which is asked is, what if I have given a donation, say, for another charitable trust where there are common trustees? Does that, so just because there are common trustees, it does not become a specified person, because in case of a Section 8 or 25 company, the question here is, that entity will be a specified person only if it is a concern in which a trustee has a substantial interest of more than 20%. So there has to be a shareholding of a trustee of more than 25%. It's only then that this will get attracted. Or that trust is a substantial contributor to you. It's only then, because then that is a substantial contributor and therefore you cannot give a donation. It's only in those circumstances that it becomes, that it becomes a specified person. Just because there are common trustees, it need not mean that it's a specified person. Only the income which is applied for the benefit of specified person will lose the exemption. It would be, as I said, it would be taxable at 30% plus applicable surcharge under 115 BBI. There may also be a penalty under 271 AAE, which is, I think, something which you keep in mind. Impermissible investments, there's a loss of exemption. See, you have the list investment pattern under Section 11(5). If that investment pattern is not followed, you make an investment which is not permitted, then to the extent of the impermissible investment, you lose your exemption. Now, what happens is that you lose your exemption. It does not mean, say, for instance, your income is 1 crore, but you invested 5 crore in an impermissible investment. Does it mean that 5 crore becomes your income? No, it doesn't. What will happen is, to the extent of the impermissible investment that you made during the year, whatever is your income, that income loses exemption. So 1 crore will be a loss of exemption in that situation. Not 5 crore will not be your income in that situation. Here also such income would be taxable at 30% plus applicable surcharge and cess. In case of business, I think just what you need to do is, there is a concept of business held in trust, which has been settled in trust on the trust and therefore held as part of the corpus of the trust. That business is entitled to exemption. The whole object, the Supreme Court in Orda's case has said that any activity within the object generating substantial markup or cost would be an incidental business. And it's not the main object itself, but something which is incidental. So therefore, you've got to examine if it's an incidental business, whether 11(4)(a) separate books of accounts are maintained. If not, the business income is not entitled to the exemption if books of accounts are not maintained separately. If it's an object, and what is separate books of account, that you should be able to keep on the separate profit and loss and balance sheet, you should be able to provide for that business. That's the way you should look at it. If it's an object of general public utility, the business is carried on in the course of achieving general public utility, and the gross receipts from the business is in excess of 20% of the gross receipts, then there is a loss of exemption for the entire income of the trust. So therefore, that's something which the provisor to 215, which you need to keep in mind. But today, if the provisor to 215 applies, you don't pay tax on the gross income or on the income without any exemption at all. The computation is to be done under Section 1310. And what does Section 1310 does? In 3 cases, Section 1310 applies, where the first provisor to 215 applies, or the income tax return is not filed before the due date, or the audit report under 12A is not filed before the due date. In these 3 circumstances, it applies. The income is to be computed after allowing deduction for expenditure incurred on objects of the trust. You will not get deduction for capital expenditure from opening corpus or from loan or borrowing, which in any case is not, or on asset depreciation whose cost has been claimed as application of income, depreciation on that, for that, in any case. Further, you will not get deduction for contribution or donation to any person. Now, when you're talking about contribution or donation to any person, it does not mean relief of poverty or disaster relief or medical relief to individuals. What you're talking about is to another organization is what is intended over here. And I think that's the way you should look at it. Of course, 40A 1A and 40A 3, that is for non-deduction of TDS and cash expenditure, that will apply. Over here, you will not be allowed a deduction to that extent, what is prohibited. And no deduction for any other expenditure or allowance or set off any losses allowable to you as a deduction in this case. So that is, I think, the broad perspective of computation of income. Try to cover it in the short time available. And I think, so we can then look at, of course, at the end, we can take questions. But obviously, I think I'll hand over to Ashok for his Deepak. Yeah, if you'd like.
Thank you, Gautam Bhai. BCA for this opportunity. It's an honor to be speaking with Gautam bhai. So basically, you need to before we go to the returns, Gautam bhai has already dealt with this filing of Form 9 and Form 10. There was one question in the question box. Since I was free, I was looking at the questions. So can I file my forms by the due date of filing return 31st October? Apparently, yes. There is a circular of number 6 of 24th May 2023, which does not have a year specific. So that circular says that date is extended to to the due date of filing return. One can take advantage. If you can do it, you should do it by 31st August, which is the as per the Income Tax Act. If you can't, you can take chance with that 31st October. The circular is still valid because it is not year specific and it has not been withdrawn. Form 10B and 10BB need to be filed before 30th September. It's the audit report. We'll be dealing in detail to a certain extent. Form 10B and 10BB have not been, new forms have not been notified. So there's one change about that 85% donations to other trusts being treated only as 85% in application. The return has been amended, but 10B and 10BB has not been amended. So there you have to write the full amounts as auditors, and the return is being amended. We'll be dealing with it separately. And your income tax return has to be filed before 31st October 2024. The due date of filing return, everyone, all charitable trusts registered under 12AB are required to file the return before the due date if they want to claim exemption under Section 11. The due date of filing return is 31st October for trusts which are required to get their books of accounts audited either under the Maharashtra Public Trust Act or under the Companies Act, in case of Section 8 companies, or under the Income Tax Act and in Form 10B and 10BB. Non-filing of return, you will have to, you will not get Section 11 and you will have to compute the income based on Section 1310, which has just been dealt with, Gautam bhai. The audit report under 10B and 10BB is required to be filed only if your receipts are in excess of the maximum amount not liable to tax for individuals. Now, this 2,50,000 is the gross receipts. It's not the net receipts after expenses. So gross receipts have to be considered. In case of trust is not registered under the Income Tax Act under 12B, in that case, ITR 5 or ITR 6 in case of companies needs to be filed as AOP or company. Possibly in the first year when you have still to apply for registration, you missed out. You have a situation where you have to do it. Now, the ITR 7 can be filed by all these types of identities. So you have wholly for charitable and religious trust, we can file it, political parties, research association, news agencies, associations or institutions are 1023A. So there's a whole list of it. I've listed them. We are going to deal only with regard to charitable trust. We are not dealing with all the other type of organizations. So there are schedules which are only applicable to charitable trust. I'm dealing with only those schedules. I've listed those schedules in the next slide. So you have to fill up those schedules. Gautam bhai has already told you that you need to file the income based on the commercial sense and not as per heads of income. So we'll be dealing with in detail later on. So can companies file register under Section 8 file ITR 7? The answer is yes. There's an FAQ issued by the department. ITR 7 form can be used by persons, including companies who are required to furnish return under 139(4)(a), 4B, 4C, and 4D. Now, the general structure of ITR. The ITR 7 form has been divided into Part A, Part B, and schedules. Part A is general information. We'll be dealing with it in detail later on. Part B talks about the computation of income and the tax payable, the TDS schedules, the advance tax, the TCS, like in your normal return. Schedules are specifically required for compliance of various provisions of law. So whatever you all have dealt with, Gautam bhai has dealt with regard to 11 to the other 9A forms, the tables are to be filled up. We'll be dealing with it in detail. The return of charitable trust has to be filed up based on the income and expenditure in the normal accounting or commercial sense. The heads of income is not applicable. The return is in the form of a cash flow, so a fund flow. So what is the receipts, where you spend it, and what is the source of those spending. So if you spend, so in no case can a trust have a loss, which already is dealt with, Gautam bhai. When we go ahead, we'll do it in detail as to how you cannot have a loss in the case of trust. You can either have a either it is from your corpus donation or from previous accumulations of 15%, or it could be for some specific donations received. You cannot have a situation where you have spent it without a source. So the source of spending also is to be given where you spend it from. That decides what is the application we'll be dealing with in when you receive, we go to that particular schedule. Now, these are the schedules which you need to fill in case of all charitable trust, provided those are applicable, like the accumulation and all. So first, schedule I talks about accumulation under 1110 or the form 10, which you fill up. Then you have the schedule IA. If you have not satisfied the conditions, tax is to be levied. What is the tax which you've paid in earlier assessment years on the accumulations? That is the schedule IA. Then you have schedule D, that is the 9A accumulation, where clause 2 explanation 1 to 11.1, where you've not received the money or for any other reason you have accumulated. DA is a schedule which deals with the taxing of these amounts which you've not spent in the earlier assessment year. You need to give it in a tabular fashion. Schedule J is your schedule of corpus donations. We'll be dealing with Schedule J in detail with examples as to what are the various ways in which you need to fill it up. Schedule VC is the voluntary contribution schedule. You have to give your balance sheet as on 31st March. Schedule R is the reconciliation of corpus donation as per Schedule J and what is shown in your balance sheet. So it is possible that the balance sheet shows a higher amount, whereas Schedule J shows a lower amount. And what is the reason? There is a reconciliation to be provided. AI is the aggregate income derived in the previous year, excluding voluntary donations. Schedule A is voluntary donation has a separate schedule. So AI only deals with other incomes. Schedule A is the expenditure details. What are the various expenditures incurred in the various heads? Here they've amended and included the donation to other trusts, and therefore 85% is taken based on automatically. Schedule 115 BBI is the schedule where if there is any specified income as provided under 115 BBI, you need to provide those amounts. Computation of total income, we'll be dealing with that, and the computation of tax liability on the total income. We'll be dealing only with these schedules. There are a list of other, these are the other schedules. We do not intend dealing with this because these are schedules not for charitable trust, except for Schedule 115 TD. In a rare case where registration is cancelled and you have to pay tax on the accredited income, this particular schedule would come into effect. But since in majority of cases this will not be applicable, we'll not be doing this in this particular session. The new tax audit form was specified on 21st February 2023. Two forms were specified, 10B and 10BB. This was based on the recommendation of the audit CAG audit team, where they had shown that the 10B, the original 10B was not giving much of information, and therefore this detailed form 10B and 10BB has been given. Now you have to fill up 10B, which is a longer form, in case your receipts, gross receipts are above 5 crores, in case you've received any foreign contribution during the previous year, or in cases where you have applied any part of the income outside India during the previous year. In these three cases, you need to fill up form 10B. Trust me, 10B is a complete assessment of the charitable trust, which the trust pays for. 10BB is a smaller form. It does not require the certifications in all cases. However, it contains complete details. So to a certain extent, lesser certification, but yes, you are certifying the entire return, ITR 7, as a chartered accountant. If the FCRA account has been frozen and cancellation process is on due to some technical fault, or it could be that the FCRA account has license has not been renewed, which form do you fill up? Now, if you look at the condition, it says if you have received any foreign contribution. So if in a particular year, if your account is frozen, that is not important, or a license is cancelled. Have you received foreign contribution during the year? If you have received, then you need to fill up Form 10B. Or if you have received interest on the saving account, which is there in the SBI for FCRA, and you've received interest on that, that is also treated as FCRA amount, and therefore you will have to fill up Form 10B in those cases. What is meant by has applied any part of its income outside India? Gautam sir has already done it. So I'll not dwell too much on it. Karnataka High Court judgment is something which I also rely on to say that if I spend money abroad, but the purpose is to get benefit in India or to give benefit in India, that is not application outside India. And therefore, I would take it as a sense that I have not spent outside India and therefore would fill 10BB and not 10B. Next is what is total income? You have to take the gross receipts. So supposing I have collected 5 crores for an object and I have spent 3.5 crores for that object. Is it that my total receipts, total income is only 1.5 crores? The answer is no. You have to look at the gross receipts and you need to take up the entire amount which is received and not the net amount. The certification in 10BB, I just wanted to highlight the amount or extent of responsibility which you are taking as a auditor of the trust. You are first specifying that balance sheet and income expenditure are in agreement with the books of accounts. Then you go ahead and you say that you've obtained all information explanation to the best of your knowledge. You also say that proper books of accounts have been maintained. And trust me, you should read Rule 17AA before you actually get into it. The details required are really extremely onerous. And I don't know which trust would be able to satisfy everything. You as trustees need to take a practical view, what is required of the trust and whether reasonable compliance is done with those books of accounts. However, there is a risk. You need to read Rule 17AA. I would have dealt with it, but since the time is short, I'll not deal separately with Rule 17AA. In case you are maintaining books of accounts in a place other than your registered address. Now, there was no concept of registered address till very recently. After the notification of Rule 17AA, the trust where the address where the trust is registered is the registered address. If the books of accounts are being maintained at other places, you are supposed to pass a resolution. You're supposed to inform the assessing officer that these books are maintained at some other place. As an auditor, your responsibility to see that this is done. Besides that, earlier there's a certification that the annexures filled up in 10B and 10BB are true and correct. Now, true and correct has far greater responsibility. You as chartered accountants are aware. I need not dwell on it. Similarly, you also thereafter certify that the accounts are true and fair. So a huge liability on the auditors. Form 10B only required earlier required to certify that in their opinion, the best information, true and fair view. This was the old certification which you used to do. Now you are saying that it's true and correct. A true and correct view implies that there is absolutely no error in the figures which are filled up in the annexures and the details which are filled up. So the 10B has 49 subclauses, 29 schedules. 10BB has 32 subclauses and 7 schedules. The annexures to 10B and 10BB effectively gets the entire return certified. I've already covered this. 10B goes beyond return of income. I'll show you. I've made a comparative chart in which places the ITR requires lesser details than the Form 10B. You are giving more details in 10B than provided even in the ITR. It's practically the entire assessment is being done by you at free of cost. At a cost to the trust. Trust pays for you. The said form is likely to cause a lot of hardship. The 10BB is a simpler form, 32 clauses. However, the responsibility is not less. Only thing is detailed in the formats which are required are not asked for. Schedules are not many schedules. You need to put one consolidated figure, but certification is still there. as I was saying, a comparative chart is prepared by my office. I need to thank Devin Shah, who's we presented together. And this is something which has done at his office. Now, if you look at various places, ITR 7 has lesser details. So in various places, I've shown that ITR 7 has lesser details. The intention is to give a comparative chart. When you, at any point of time, you want to check whether the return and the ITR form, the 10B and ITR are, compare them and see whether details are properly. This becomes handy to go there and check those few items. And ITR 7 in most of the cases has lesser details compared to 10B. I have lesser time, so I'm not going to get into 10B and 10BB in great detail. I'm just going to make it comparative with the ITR. These are the areas where 10B requires schedules and 10BB is not requiring these schedules. 10B has some 12 areas where you give details about. So these are the details which are required in 10B. 10BB has 25 areas where you required to give details. It's a more detailed form and it's almost an assessment. Comparison of 10BB with 10B and the ITR. So this is the basic details which you certify in as a 10B and 10BB charter auditor. PAN of the auditee, name of the auditee, assessment year, previous year, that's all registered address of the auditee. Now, it is possible that the trust is operating from a different address in the current period than the registered address given in the PAN or the registration certificate. See that the address is changed. As the auditor, it is your responsibility to see that the information given is true and correct. So therefore, please see that this is checked. This is something which gets overlooked. The other address is in column 6 marked red. Is the disclosure of other places where the books of accounts are maintained. It is possible that the trust out of oversight and the previous auditor out of oversight has missed out on sending a letter to the assessing officer. If you are able to send the letter even today with to the assessing officer before the audit gets over, it's better. Type of trust. A trust can be in the form of charitable trust, society, company, or it can be some other form. You need to specify. Generally, most of the trust has established wide an instrument. Not oral trust were an old thing. I don't think any of those trust, even in old trust where you go to charity commissioner, you had to put down in a written form and submit it to the charity commissioner. I've covered this. Yeah, this is the certification. This is ITR 7 as the same certification as you've given in the audit report. I need not get into detail. If there are any questions, I'll address it. One word of caution. There is the habit where mobile numbers of chartered accountant gets filled in return and email addresses. Please avoid it as far as possible. You deal with a lot of clients. It is possible that a message or a mail is missed out. So you should see that your email address or your phone number is not put in the return. With regard to this detail about projects and institutions, if you are running any project or institution, please fill up the name of the school and an institution being run during the year. Please match this with what you filled up with Form 10A. So while taking registration, you had filled up Form 10A, you had given certain project report details. Generally, you should match it with that. This is also basic details. A19 talks about details of registration. If all trusts are supposed to get registered under section 12A if they want to claim section 12AB, if they want to claim exemption under section 11. For that purpose, so when you fill up the return, you should see that you fill up this particular A19 table. One should also be careful that if you have received provisional registration, then provisional registrations were received initially even for certain trust where they were already holding registration, and by mistake the the online system had issued provisional registration to certain existing trusts also. In those cases, there is one circular 11 which says that those registrations are permanent registrations. Therefore, you need not fill up as provisional. Those registrations are permanent. However, those registrations were for 3 years only. Now, if you missed out, those 3 years were getting over in March 24. If you missed out, please check those trusts where if you missed out on 6 months prior to registration getting complaint, though under circular 11, they had said that this is the regular registration, not a provisional registration. They had not extended the time from 3 years to 5 years. So registration, if it is for 3 years, you had to get it renewed before 31st, 6 months prior to 31st March 24. Fortunately, in this budget, they have given power to the commissioner from 1st October to extend, in case of delay in filing these registration applications, to give a condonation. If you are a new trust and you've got provisional registration, you need to, within 6 months of starting the activity, file form 10AB. If the trust has not filed it, you as auditor should see that it is filed in time by the trust. If you have other registration in the form of FCRA or the Darpan portal, then it should be mentioned over here. If you have an FCRA registration, the certain trust, recently we had a trust where they claimed that they had a FCRA registration. When we went online, it was realized that that registration was never renewed. It has to be renewed every 5 years. If you don't renew it, it gets closed. The account gets blocked. And therefore, one needs, as an auditor, one needs to see that one does proper due diligence before they fill up details, because this is going to be certified by you as an auditor, and 10BB and 10B also. I'll show you the relevant places where you are supposed to fill this up. Next, so if you don't fill up by mistake, if you miss out on filling up this registration column, of course, the utility now raises a red flag. However, you ignore that and you file the return, then the 143(1) will be received by calculating income under 1310 automatically. A lot of deductions and all will not be allowed. I've covered the other parts. Yeah. So this is 10B and 10BB require you to give registration details. So why I was telling you that you should pay attention to what is the nature of registration is because you are certifying it in this table when you fill up 10B and 10BB. Therefore, please be careful when you fill up these details. You are certifying practically the return through this particular audit report. You have a code. So they ask you a section under which you are registered. There is a code given. There is a code provided in the instructions to form 10B. One can go through those instructions and fill up those codes. Please fill up the correct code. Not filling up the filling up an incorrect code could lead to an error. Then you also, so if you have a provisional registration, in the certificate, they ask you whether you have applied in form 10B, 10AB, whether activities have commenced, and whether you've applied for final registration after activities being activities having started. What is the date on which you have applied for registration? All these details have to be filled up by you. This is with regard to return, and under which section are you filling up the return? So return needs to be filled up under 139(4)(a). You also, for a charitable trust, you also need to specify the section under which you are claiming. So if you have filled it up under 139(4)(a), this particular schedule will only show you section 11. There are two important things which you need to note in this particular schedule. One is the whether any income included in the total income which you are opting for section 1990A. So supposing you've made an investment abroad and you have certain income which has already been taxed, you can claim abroad, then you can claim section 90, 90 and 91. Generally, the trust would not do it. But unless you say yes, the foreign asset and income schedule does not get activated in the utility. So you need to see that you say yes if you have foreign income, for you to fill up details in the foreign income columns and the foreign assets columns. if a partnership, the trust is a partner in a partnership firm, the details need to be mentioned over here. A new entrant for 24-25 is the legal entity identifier. If the trust has a legal entity identifier number, one should take it and mention it over here. A22, whether you have unlisted equity shares. The trust, as per 11.5 and as per the Charity Commissioner, is not allowed to invest in unlisted equity shares unless it's a public company, run public sector company. If you have shares which are unlisted and you mention it over here, it is possible that you have received that donation in the form of a non-cash donation. In that case, you need to look at 13.1D, which says that you need to dispose of or the asset which is in not compliant with 11.5 within 1 year period. So there is proviso to 13.1D, which allows you to hold it for 1 year. However, any income generated during that period will be taxed under 115 BVI at 30% plus the surcharge applicable. So you need to give the information about the unlisted shares in this particular schedule. A23 talks about the commercial activity. So under provisional 215 says that if you have carried on any business or profession or any services which is a nature of the trade, commerce or business, and in that case, it should be incidental to your business. Second, it should not be more than 20% of your gross receipts. If it is more than that, then section 13.8 says that you will not get section 11 exemption. This particular A23 requires you to give details whether you are covered under general public utility. If yes, whether any trade, business or profession is pending, whether there is any activity in the nature of trade, commerce. If yes, whether it is, what is the percentage, whether this trade business activity is incidental to the activities of your trust, and what is the nature of, what is the total gross receipts to the percentage. They also request you to give the name of the project or institution and amount aggregate annual receipt from that activity. So the business activity details also have to be given over here. If there is any change in the objects of the trust, which is likely to affect the registration originally given, in that case, one has to apply for re-registration within 30 days. A24 requires you to fill up this. Both A23 and A24 are covered under clause 15 and 16 of form 10B. You are going to certify it. So please see that you fill up these details properly, as this would be certified by you. This is the schedule in your form 10B, which you need to fill up. I was telling you that you need to certify this. I've reproduced the schedule. Let's not waste time on it. Let's go ahead. The nature of activity which the trust is carrying on over your object of the trust. There is a coding system which is available. So please look at the code in the instruction sheet. You need to look at the instruction code and do it accordingly. Yes, with regard to advancement of general public utility, this is the schedule which you fill up in 10B. We need a separate session for 10B and 10BB. So I'm not going to get into too much detail. However, you are certifying what you've written in the return. Please fill it up carefully. This is something which is come in new this year only. Assessment year 24-25, the return has been amended to include with regard to commercial activities carried on by a trust covered under 1023 subclause 4, 5, 6 and 6A. In that case, the same details as under the proviso are to be filled up in 826. it's a complicated 1023C. We are not dealing in detail over here, so let's not waste time. If you have violated the commercial conditions, and you, in that case, 13.8 says no deduction, and you compute the income based on 13.10. Audit information. So if you have done audit under 10B and 10BB, you need to give details. The additional detail which you need to give over here is the acknowledgement number of the audit report filed and the UDIN number. So those two additional details have been added to the this year's return of income. Then you, if you have audit under some other act, then you need to fill it up over here. One needs to be careful. In some cases, 10B and 10BB does not applicable because your gross receipts are less than 2,50,000, and you forget to fill up the charity commissioner's detail in the 828. Then in that case, it will amount to that you do not have audit, and therefore what they will process is that the return is late, and they will deny you the benefit of section 11. I'm fighting a small appeal with regard to this. Therefore, I wanted to point out that please see that you fill up the audit details. Only then your return due date is 31st October. Otherwise, the due date has already gone on 31st July. 829 talks about details of the authors, shareholders in case of section 8, details of trustees. You are and people who have made substantial contribution during the current year. So we are taking it, the understanding which we are taking is that contributed more than 50,000 in the current previous year, because it is impossible to keep track of 50,000 during the lifetime of the trust. So a practical view is to, and I think there was a clarification issued by CBDT. I'll go a bit fast because I need to complete my presentation. The details also require you to give details of relatives of the trustees. Now, it is very difficult to ask for details of relatives. One will have to somehow convince the trustees to give details of relatives and fill that details over here. So you need to give the entire details. This detail is certified by you. So you as auditors, this is the schedule which you fill up in 10B and 10BB. Please see that you fill it up after taking on record the resolutions, the charity commissioner change report forms which are filed, or in case of companies, see that the forms, necessary forms in MCA website are filed, and keep them on record as an auditor. There was one question which was asked prior to the session saying that, do I need to qualify because the change reports have been not been filed, or the accounts are not submitted to MCA? My answer is no. You need not qualify. It is not the non-filing does not affect your operation. So when one looks at 12AB and the conditions given under that, saying that only if it is going to affect your activities of the trust, then you need to mention it. However, a word of caution, accounting standards require the auditor to notify any violation of any law. So please look at what is the nature of violation. And if you think that there is a substantial violation, you may put a note in the main audit report form saying that the trust is in the process of rectifying this particular non-compliance. These are some of the codings which you're supposed to put. I'm not going to get into it. I have very less time. You also need to certify when the commencement of activities. This is registration details. Going to Schedule 1. Schedule 1 requires you to give details about accumulation. So if you've not spent, you want to accumulate for a project, you need to fill up this particular table. As Gautam has already done this, you need to give tabular information about because at the end of 5 years, this becomes taxable. The table is made in such a manner that if you have not taxed it earlier, then in that case, so if they ask for details that this is a table which you filled up, the amount of accumulation, purpose of accumulation, amount applied till date, what is the balance amount? Amount taxed in the earlier assessment year, if there is any taxation, balance amount applied for charitable religious purpose during the previous year out of the previous accumulation. So it is possible 18, 19 is spent in this year, in the 5th year. So you need to fill up these details. This is Schedule IA talks about details of accumulated taxed in earlier years. So if you have not taxed it, if you fill up that form, the tables properly, if you have not taxed it, reopening is likely to take up because AI would or the computer system will automatically red flag it and reopen it. However, since except for bigger trust, only last 3 years accounts can be reopened. So to that extent, you are protected. Uh, the information in the sought in the return is also, if you look at only the last 4 years, information is required with regard to this. Similarly, for Form 9A, where you are not able to spend the amount because you have not received it or for any other reason, and you fill up Form 9A, the details have to be filled up over here. For this Schedule D and Schedule DI, I am going to take up an example so it will become more clearer. So Schedule DA basically talks about what is taxed earlier because of non-utilization of the funds or not spending it. Now, there is one minor difference between Form 9A accumulation and Form 11.2 accumulation. And that is that in 9A, where you are not able to spend because you did not receive it, you are allowed to donate it to other trusts. Whereas in regard to 11.2, you cannot accumulation for 5 years. You are not allowed to donate to other trust. You are supposed to spend it yourself. So that is one minor uh, uh, finer point which I wanted to bring to your notice. Now, this is an example. So in the last year, there was an accumulation of 131,817 because of other reasons you are not able to spend it. Out of the deemed application claim amount required to be applied. So in the current year, 22-23, that was other reason. So 23-24, this has to be spent. So therefore, the required to be applied is 131,817 was required to be applied. Any amount which is taxed, the answer is no. Out of the deemed application claimed, amount required to be applied during the financial year. So 23-24, what was required to be applied? 131,817. If you applied that amount during the current year, this will be the figure. So this is what was required and this is how much is spent. If you have spent this, nothing will be taxable. You get 0. Similarly, 22-23, if income was not received, if that amount was required to be applied is 131,817. Amount taxed is 0. Was it required to be applied in 23-24? The answer is no. Even if you have received in 23-24, you can spend it in the previous year following. So 24-25 previous year, and therefore 0, and this amount will have to be spent later on. However, in case of other reasons, if supposing you have not spent the amount, so you 131,817 was to be spent, you have not spent the amount, in that case, it will become taxable under section 11(1)(b). This is just because this particular table is complicated. This example was taken up just to explain what columns to fill up and for what reason. Corpus donation, Schedule J. We'll spend some time on this. So here, Schedule J, you are supposed to mention only corpus is not applied. So if you have not applied and that is kept in an FD or a bank account, that only has to be shown over here. So there are 3 bifurcations. If you are taken it for repair of corpus, for repair of place of notified under temples, under ATG 2B, temples, gurudwaras and all that, or other than above received on or after 1/4/21. So if you've received some corpus donation after 1/4/21, the reason being after 1/4/21, there was a condition of investing in 11(5) and otherwise it being taxable was brought in. And the fact that application from corpus was not allowed for deduction. So therefore, they bifurcated before, after 1/4/21 and other than prior to that. We'll be doing an example, so which will make it more clear. Received or treated as corpus during the year, applied during the year, amount invested. So you need to fill up this table. Let's not waste time. This particular table is going to be certified by you under 10B. So I'm not brought the table over here, but the same table is put in 10B in schedule of corpus, and chartered accountant is supposed to certify as true and correct. So you need to look at all the previous forms and see that if proper accounting is not done, I don't know what is going to happen. You will have to put a qualification or give a saying that the data is not available. However, generally you should be able to work out this particular data. Uh, Besides that, if you have taken money, you've borrowed funds and then applied, you need to fill up this borrowing table. A word of caution, charitable trust in Maharashtra cannot borrow without charity commissioner's permission. So please ask the trust to take it post facto if they've not already taken it. Then you need to fill up details about corpus investment. So whatever corpus donation, whether you've invested, you need to give investment details in this B schedule. So whatever corpus you have not spent needs to be invested in this particular B schedule. If you don't invest it in that, then it becomes taxable. So therefore, you have this last column, investment in modes other than specified in 11.5. If you've invested in modes other than, this becomes taxable. This will be taken, this figure will directly be taken to your computation income, and this will be taxable at in the computation of income. Yes. Now, going ahead. So, if you have invested in any concern which 13.3 with your related parties, you need to give details over here in C schedule. In D, investments, other investments on the last day of the previous year, name of the concern, where you've invested, if it is not in 11.5. Any donation in kind which is not converted within the time specific in the 11.5, then you need to give details of these donations, donation received and not converted within a time provided of 1 year. So you need to give details over here about donations in kind. This also is to be certified. All these tables, 10B covers them. You need to certify the details given over there should match with this particular schedules over here. Consolidated balance sheet. Again, the bifurcation of corpus donation is given over here. So whatever figure which you fill up has to be reconciled with the schedule J. We'll do an example to make life easier. Investments, there's no bifurcation, only one figure of investments. If you have a loss, one needs to put it over here. Yes. Schedule R. Schedule R is basically reconciliation. Whatever is your closing balance as per Schedule J and whatever is your closing balance as per balance sheet, that difference could be because you've purchased a fixed asset, because you've done depreciation or any other reason. In that case, you need to give the reasons. We'll be doing an example because this is something on which we receive a lot of queries regularly. So I have taken two examples. First is a case where you have 50 lakhs worth of corpus donation. 40 lakhs is received prior to 1/4/21. 10 lakhs is received after 1/4/21 in 23/24. 20 lakhs is the assets after depreciation. Fixed deposits are 10 lakhs. Bank balance is 5 lakhs. And there is a carry forward loss of 15 lakhs. So on the credit side, there is 50 lakhs. On the debit side also, if you total up, there is 50 lakh rupees in the form of fixed asset, fixed deposits, bank balance, and income expenditure debit balance. Let's look at the example. So you have only 15 lakhs, which is not applied. Out of the 50 lakh rupees, 15 lakhs is not applied towards the corpus donation is not applied. Therefore, if you look at corpus not applied till 31st March, what is not applied is 10 lakhs and 5 lakhs. 10 lakhs is after 1/4/21. It is received during the previous year 23/24. Therefore, 10 lakhs is written over here. You have not spent that amount. It is lying in your closing balance. It is invested in fixed deposit. Therefore, it is in to be filled up over here. Similarly, 5 lakhs is the opening balance. There is no additions. other, because this is prior to 1/4/21, there is no addition 5 lakhs. It is lying in your bank account, which is 11(5) compliant, and therefore you fill up 5 lakhs over here. This is the table. If any amount is filled up in this column number 10, that will become taxable straight. It will be taken to your computation. Reconciliation. The 10 lakhs received after 1/4/21, you have invested closing balance 10 lakhs tallies. 5 lakhs corpus donation, it was 50 lakh rupees, 40 lakh rupees. However, if you look at the bifurcation is you've got fixed assets worth 20 lakhs and you have any other, that is the carry forward losses of 15 lakh rupees. This 35 lakh rupees with 5 lakhs becomes 40 lakhs. The total of these two figure will be 50 lakh rupees, which will tally with your balance sheet over here of 50 lakh rupees. So therefore, this is how you need to present it for corpus donation. Similarly, supposing you have surplus, you've not spent the corpus. In that case, there is no problem. 50 lakhs is the corpus donation. You have never used it. You have fixed asset, fixed deposit worth 5675. Bank balance of 325. Total is 60 lakh rupees. And your income expenditure profit is 10 lakh rupees. So therefore, credit balance has 50 lakhs corpus and 10 lakhs profit. That is 60 lakhs. And your debit side has fixed deposit and balances. In this case, how would you show it? Here, there is no problem. This is prior to 1/4/21. 50 lakhs is the opening balance. Closing balance remains 50 lakhs. Invested in modes of 11(5) is 50 lakh rupees. Over here also, there is no reconciliation to be prepared because that is matching. Next, you need to fill up details of income. I'll take 5 more minutes, sir. Is it okay, Deepak?
Yeah, okay, no problem.
Yeah. So details of income, schedule AI. Here you need to give details other than voluntary donations. The bifurcation is receipts from main objects, receipts from incidental objects, that is school fees. If you are running a school fees, if you are running a dance class, certain fees is collected. All that would go into receipts from main objects or receipt from incidental objects. Any rental, commission, dividend, interest income, agricultural income, all this will be filled up into various head. Any other income you need to fill up. Any pass-through income you need to fill up over here. This again is certified by you in 10B and 10BB. Those figures have to match. So therefore, while filling up, you should see that at least your 10B and 10BB figures are correct. If incorrect figure is over here, then it is okay. But if there's an incorrect figure in your audit report, disciplinary actions can be taken. Similarly, you have bifurcation of voluntary contribution. Voluntary contribution has to be bifurcated into 4 parts. Domestic contribution coming from corpus donation. Non-corpus donation are of 2 types. Again, you have other than corpus donations. You have grant receipt from governments. You have grant receipt from CSR and any other specific grants or other donations. Then you have foreign contribution, again, bifurcation into corpus and non-corpus. And after that, you have the enormous donations where you would take the total enormous donation minus. So therefore, it is not taxable up to 1 lakh or 5% of total donation. Now, 5% of total donation would include the enormous donation. The system tells you that way. So if you look at what does the system say, this is the total donation which is received from FCRA and the local donations, that is C. And D1 is the total enormous donation. Both have to be taken total, and then 5% is calculated on that. So 5% of total donation or 1 lakh, whichever is higher, is exempt. No enormous donation is taxable to that extent. Above that will be taxable at 30%. So this is what the bifurcation which you are supposed to give of donations. Coming to application of fund, Schedule A. Now, this application of funds requires you to bifurcate it between revenue and capital. 85% donation. Here you have this particular thing inserted from assessment year 24-25 applicable from this year. So in this case, if you look at the return, you need to give the gross figure. It automatically calculates 15% and 85% and takes the other amount over here. Now 10B and 10BB does not have this particular bifurcation, and therefore you will not be able to fill up. So currently it is not amended. My hunch is that they will come out with a amended 10B and 10BB as soon as they realize this, and come out with it at the last moment. However, if you fill up the 10B and 10BB before that, no harm is there. You could fill it up. But however, that would not match over here. You could put a note to that effect in your 10BB that this is place is not available, and therefore it is included in this thing. So relief for poor, education, yoga, all this needs to be filled up as application of fund. Then you go to the disallowance from the application of fund. These are the disallowance of expenses. Disallowances, if you have made a donation to another trust as corpus donation, that is the B1. After that, you have donation from accumulated income. So if you have done accumulation under 11.2, you can't give donation from that. If you've done that, then that is to be disallowed. Not having the same, if you've given it to a trust, not having the same objects, that is not application of funds. Donation to any person other than trust or institution. Now, I do not agree with this. There is no law that I cannot donate to an institution. It should have similar objects. So can it be widely said that if I give donation to a needy person, medical help to a needy person, this would get covered over here because he is a person other than trust? I would not think that way. I would read it in the fashion that if you can't give it to an unregistered trust or institution, don't make it so wide as to include even individuals. A reasonable view should be taken. So all these are to be disallowed. Any application of funds abroad without permission, any application of funds beyond the object of the trust or institution, any other disallowance are to be made. Okay. Similarly, you have to give the source of funds. Where did you use the funds from? So income derived from any property income during the previous year, excluding corpus. So this is from your revenue sources. So if there is any accumulation, 11.2, you've used it from that. Besides filling 11.2 table, you need to also give it over here. So if you, because if the expenses are included, you need to provide it over here that it should be removed, that the source is this. Income deemed to applied from your 9A form, that is clause 2, which you've accumulated by filling up 9A. Similarly, anything from 15% accumulated balance, corpus donation, and borrowed funds. Sir has already covered how it can be claimed, so I'm not getting into, I'm just getting into filling up the forms. I have no time left for any further explanations. Total income computation. When you fill up the form correctly, all these figures are auto-filled. All these figures are auto-filled. 1, 2, 3, 4, 3, 5. All these figures are auto-filled. You will only have to check whether they are properly filled. Reference to those schedules are also made. Similarly, all these figures, if you see wherever you have marked numbers, they are auto-filled figures, and you need to fill this up and you get the computation of income. 115 BBI is to be taxed at 30%. All these other incomes, in majority of the cases. So there was one question in question and answer that amount disallowable under 40AI is taxed separately. The answer is yes. The utility, so the law is different. However, the utility taxes the non-deduction of TDS amount and this as a separate taxable income at 30%. Next, this is an schedule 115 BBI. The violations, so these are specified income. These incomes are taxable at 30%. I need to mention over here that controversy with regard to 13.1C and 13.1D violation. Here it says taxable at 30%. You also have 164, section 164(2) proviso, which says it should be taxed at MMR. However, since 115 BBI is a specific section and it has come later on, I would tax it at 30% and not as MMR. there is a minor difference between what is MMR and what is taxable at 30% plus applicable surcharge. There is a minor difference when you are not in the maximum rate. I have time only for this. There were two questions which were asked before, so I'll just answer them before I take up other questions. If my income is less than 2,50,000, if your income is less than 2,50,000, but if there is violation of 115 BBI, you need to pay it at 30%. Those specified incomes will have to be paid at 30%. There is no MMR taxation to a charitable trust. Please look at section 164(2). Charitable trust have to be taxed at the normal slab rates. However, very few incomes are now left with the introduction of 115 BBI. I think the other controversy about 13(1)(c) and 13(1)(d) I've already covered. If charity commissioners, this also I've already covered. Thank you for a patient hearing. I'm sorry I've overshot by 10-15 minutes. Thank you. We can take the questions now.
Yeah, thank you, Ashok. In case of a trust engaged in providing educational services, can we apply 15% of accumulation of income after deducting operating expenditure incurred to run the school or college from the gross receipt, or it should be directly applied on the gross income?
See, I think in the case of an educational institution, now what is your expenditure on for charitable purposes? It is the expenditure on the running of the school. So therefore, in that situation, I would say that it was the gross income which you would consider and not the net surplus of the school in such a situation.
The next question is, in our case, trust has accrued interest income, FD and income tax refund. However, trust has made application of full income received during the year, including amount accrued interest, income due to availability of past funds. In this case, whether trust has to file Form 9A or 10 for accrued interest income?
No, not necessary. No, if you have fully applied, then where's the question? So if your income of the year is applied, then you don't. It's only if something is not applied and even after 15% you have something left over, then you can choose to take that option. But otherwise, if you are fitting in, then you don't need to take that option.
Against income of 1,000 or 900 is donated to another trust and 100 is accumulated, is 150 being 15% accumulation allowable, although only 100 is unspent?
Yeah. So what will happen is 15% of 900 will be, so you will have to look at what is 15% of 900, which is 135. So 135 and 100 is unspent. So 235 is left over, of which on 1,000 you are allowed only 15%. So 150 will be this. So 85 will become your taxable income in that situation.
Can trust invest in shares of public sector companies?
So I think section 11(5), it does allow certain investments in shares. You can refer to that section 11(5) and see the specific provision. I think public sector companies is there. There is some other this also that for an incubator, it can invest in shares of startups, etc. So there are certain provisions where shares can be invested in, but you can have a look at, I think specifically go through section 11(5).
And 17C also, rule 17C.
Yeah.
Next question is, can we get details of section 115 TD, how it is calculated?
So I think that will be a whole session by itself, Deepak. 115 TD is like an exit tax. So there are some complications, etc. Yeah. It's just that it's taxed at maximum marginal rate on the net market value of the assets, effectively.
Yeah. Again, that valuation, market value, how to determine all that. Anonymous attendee, by which date compliance to be done for Rule 17AA of filing intimation with AO, with books maintained at a place other than registered office since long back?
Ashok, you can. Maybe.
Yeah, so you, if it is not done, you can do it even today. There is no penalty as of today for late intimation. Please intimate it today. Since the books of accounts are maintained, just do the intimation today and complete the compliance. You should be doing it within 7 days of the passing of the resolution, or at least from the date when the Rule 17AA had come. However, if it is not complied today, then just file it now. They are not putting any penalty for that.
To determine the limit of 5 crore for determination of audit form, do we include corporate donations as well?
Yeah, I think as per the department, I think because they regard corpus as income, and therefore that 5 crore would gross receipt would include corpus donations is the view that they would.
Trust did not apply registration during the year 14-15, but got registration subsequently. By mistake, return filed in Form 7 and claimed application under Section 11. The grant received from government for specific purposes was treated as voluntary donation by SCC. The assessing officer disallowed as per law applicable as claimed. Can trust apply for registration now with application for condonation of delay with the CBDT in view of 119(2)(b)?
Sir, you will answer?
Sorry, Deepak, can you just repeat
Should
that?
have, yeah,
It's
I'll
a
just
registration
repeat it,
issue,
yeah.
no? It's a question of registration. So
Yeah,
that
yeah. So the trust did not apply registration during the year 14-15, but got registration subsequently. By mistake, return filed in Form 7 and claimed application under Section 11. The grant received from government for specific purposes was treated as voluntary donation in the return. The assessing officer disallowed as per law application as claimed. Can trust apply for registration now with application for condonation of delay with CBDT?
So application of condonation of delay is now from 1st of October. It is now delegated to the principal commissioner or the commissioner, and therefore when you make the application now and give the reasons for the delay, seek condonation of delay from the commissioner now. You don't need to make an application to CBDT now. Is the way from 1st of October.
Okay. But that would not be again whether it would be retrospective or.
So, Deepak, the way I would look at it is that the commissioner has the power from 1st of October. So, whatever, suppose you file it now, it will be taken up for processing, etc., at a later point of time. And therefore, after 1st of October, the commissioner, when he is examining your application, he can definitely condone the delay, is the way I would look at it.
Okay. Yeah.
And with regard to the government grants, whatever is spent, you would get it under 1310. So whatever is only surplus, you would be taxable. So government grant,
The
whatever
benefit is-
specific, then that deduction under 1310 is available.
ITR 7. 19 ITR 7 in 19 registration details. If we fill Section 12A and Section 80G registration, the first one is coming as true and the next one is false in the return. How can we have both as true? Ashok?
So you need to, it's difficult to answer this question without looking at the issue per se, but in both the cases, it is coming true. Maybe you've got a wrong utility. So if you take up the latest August utility, the problem could be solved. If still does not get solved, I could address it offline. That's not an issue.
Okay. Thank you. If donations received in kind by religious trust in the form of jewelry, is it required to be sold and to be invested in 11.5 within 1 year, or can it be held in the form of jewelry?
See, what you can do is, as I mentioned, where a temple trust, say, receives jewelry, now that jewelry is, you'll have to show it not as a corpus donation, but show it as a regular donation. And against that, you say this is an application of income for charitable purpose, the acquisition of the jewelry. And that's how, so it will be an income as well as an application of income. That's how it would work.
The value to be determined by the trust himself.
Sorry?
Value of the jewelry?
Yeah, value, I think you should ideally, if you can get it valued or on estimated value based on this thing,
Market rate.
Yeah, weight, etc., of the gold content and this.
Yeah, whatever form of jewelry, diamond or whatever.
Institute in this has given a guideline that kind can be recorded 1 rupee for.
Yeah, that's in the accounting part of it.
Accounting part of it.
But, correct.
Yeah. Otherwise, you'll have to get a valuation certificate from the jeweler.
Yeah, I mean, the preferable this is that you get a valuer's report, so which values the jewelry, or at least from the donor, you get some statement saying that the approximate value of the jewelry is so much.
Okay. Next is, if there is no change in memorandum of association, but only in the activities furnished in activity note submitted at the time of registration, is registration required to be renewed?
So activities are changing, is it? But it is all within the same objects. Then you don't need to go in for re-registration. See, today, let's put it this way, that your activity is education and you're only running a school. Then you also start giving education scholarships. So there, it is all falling within the object of education. There is no change in your object. So you don't need to go in for re-registration there.
The Form 9A filed can be revised.
Ashok, would you like to take that?
Yeah, so it cannot be revised. You can file a new 9A and give a letter to the assessing officer. In one of the cases, another query of this nature was there. So we filled up the new 9A and we gave a letter saying that there was an error in filing and therefore we filed a revised 9A.
Do we still have to provide details of donors donating above 50,000 even if we don't have any transaction with them apart from donation received?
Sorry, if you don't have any?
If we don't have any transaction with them apart from the donation received.
Yeah, you're supposed to give the list. See, what happens is now, one is that you're supposed to maintain books of account. So, and the books of account has to maintain the list of specified persons. I mean, the documents which are required to maintain. Now, as an auditor, you're certifying that yes, the documents are maintained, and therefore this list of substantial contributors is also required to be maintained. That's one thing, and therefore it's advisable that you give this, details. Sorry, one point I think on the substantial contributors thing, Ashok mentioned about that, Ashok, just you may want to examine that. See, that circular last year was only, I think, a relaxation for last year, if I'm not mistaken. So, in a sense, that relaxation may not apply for the current year, and therefore, auditor may need to qualify the audit report.
Yeah, so if so there in to that extent the auditor needs to qualify the report because that circular was only for last year. Yeah, put a note, not qualify, but
Deepak, and maybe I think BCA could represent on this, saying that this is something which needs to be relooked at, since the limit of 50,000 has not been enhanced in the budget, and therefore it needs to be relooked at, and relaxation needs to be given on this count.
Further relaxation on the same circular be extended.
Correct.
Okay. Yeah. Are accounting standards of ICAI mandatorily applicable to charitable trusts, considering financial statements of trust are not general purpose financial statements, as explained in preface to AS issued by ICAI?
yeah, you as an auditor need to prepare. All accounting standards are applicable. I don't see why it should not be applicable. It is applicable. Only with regard to expend. So even if when you are maintaining, if you are a Section 8 company, you need to prepare the accounts as per accrual system. You can't go into cash basis of accounting. Similarly, all accounting standards would be applicable to the trust. I don't see, and even the auditing standards would be applicable. So therefore, in one of the questions whether I need to qualify, I had said that there is an AS 250 which auditing standard which requires you to give or any violation of any law, whether minor or not, because it's a violation of law. So auditing standard is applicable and accounting standards also are applicable. Sir, would you like to comment on this?
Yeah, Ashok, I think on the accounting standards to a trust, which is not a company per se. So there perhaps, as he rightly, the question is rightly that these are not general purpose financial statements. So strictly speaking, they don't apply. There is, of course, the technical guide on accounting for NPOs, which you referred to about the 1 rupee thing, etc., where they've talked about. So therefore, I mean, if you really look at it, and particularly if the trust is following cash system, then definitely I think, one will think that the accounting standard will not apply in that situation.
Yes, for cash basis not apply. But
Correct.
then auditing standards will apply, sir.
Yeah, auditing standard apply to an auditor in any case. So therefore, that is something which the auditor will have to.
Yes. Yes,
trust has gross receipts of 10 lakhs. It has incurred administrative expenses of 1,50,000. 1,50,000 and applied 7,50,000 towards objects of the trust. Depreciation on assets is 1,25,000, resulting in deficit of 25,000. How the source of deficit of 25,000 should be shown? Sure.
Yeah, so in this case, depreciation as per section 11(6) cannot be claimed if you have claimed the entire expenditure. So I'm assuming that he is not claimed the entire expenditure in this. in this case, the deficit, though depreciation is claimable, you will the deficit will become not carry forward. So no losses are carry forward. That particular depreciation is only a notional book entry. So it will not be allowed to be carried forward, and the loss because of depreciation will keys to not be allowed as deduction. Sir, can you add to this?
Yeah, maybe, you could put it as it is out of accumulation of 15% of earlier years, because
Yeah.
the asset would have been acquired out of that accumulation made,
Yeah.
perhaps, so that's one way of looking at
That
it.
one way of putting
Yeah.
it.
Looking at
And
it.
provided he is not claimed the entire asset as
Correct, cost of
expenditure
the asset.
question
Yeah,
was-
obviously, otherwise you would not get the depreciation.
depreciation.
So basically, the source of deficit, as Gautam said, we will have to show it from the past accumulation, correct?
Correct.
The source of deficit of 25,000. Yeah.
Yes.
Yeah.
Okay.
What is the educational expenses as per BPT? It means donation to needy child for higher formal education by paying less or running a education institute. Thus, if no not educated, it shall no education, it shall be relief for poverty. All these objectives are not clearly defined. What to refer?
Yeah, I think you have to look at it in substance, no? Ultimately, what is it in substance? I would say that for, helping a poor child get education is really, education is the greater the substance rather than relief of poverty, is the way I would look at it. Relief of poverty would be, if something falls under education, so you might help a poor person with medical relief, you might help a poor person with education, or you might help them with food, etc. So question is, if you're helping them with, medical relief or education, it would fall under medical relief or education. I think that's the way I would look at the classification.
Can a trust make
Yeah.
corpus
Sorry,
donation?
Ashok, can I take it up? Sorry.
Yeah,
Yeah,
sure.
Deepak,
Yeah,
from where
yeah,
you
sure.
left
So,
off.
from where I left. Yeah. The trust having income more than 5 crore and FCRA applicability, and also for less than 5 crore trust, where due to any reason FCRA is cancelled or bank account frozen, what precautions to be taken by the auditor?
So you have to see whether if the bank account is frozen and the renewal is not being done, one will have to see that there is no interest in that account. So if there is any interest amount, if it is more than 5 crores, you need to fill a form 10B. And with regard to is there any show cause issued? Because if there is a show cause issued by FCRA besides cancellation, then one has to look at it, because then that implication needs to be qualified to that extent. And if there is any interest in that account, again, it amounts to receipts from FCRA. Yes, sir. You would like to add
yeah.
some, sir?
No, I think that's right. Because particularly one has to be careful there to understand what was the reason for cancellation. Because if, for instance, one of the reasons for cancellation may be that the trustees have used the funds for their personal purposes, etc. So therefore, then one has to consider whether 13(1)(c) reporting is required, what is the role of an auditor. So from that perspective, whether one may need to qualify the main audit report under the Maharashtra Public Trust Act, for instance. So those are instances where one will have to look at based on the facts.
Yeah. Where to show expenses related to Gaushala in application of income?
It will come under general public utility.
General public.
There could be another view, sir. Yeah.
Yeah, so veterinary, just for your information, there is a Gujarat High Court decision in the case of, I think, Amul or the same, where they've said that veterinary treatment of animals is medical. So just for your information, that's...
Yeah. No, sir, Gaushala would include grass.
No, I agree. That Gaushala in general, yes. But if it is veterinary treatment, then that would be medical.
Medical. Okay. Do we still have to provide details of donors donating above 50,000 even if we don't have any transaction? That is already answered.
Covered.
Yeah. Utility is not providing basic exemption limit in case income is below 2.5 lakh, taxing same as per 115 BBI.
Yeah, so if you are covered by 115 BBI, you need to pay tax at 30%. There is no basic exemption for items which are covered under 115. So specified incomes under 115 BBI, those 5 items have to be taxed at 30%. There is no basic exemption of 2,50,000.
But for income other than falling under 115 BBI?
There is basic exemption available, and it is the utility is giving it also. So I don't think there is a problem with regard to other incomes, but those covered under 115 BBI have to be taxed at 30%.
I believe last year there was some issue in the initial returns.
That has
Last
got
year it was
rectified.
taxing their accumulation, unspent
Yeah.
accumulation was taxing it as amount
Correct.
left
So that's
over.
why the reason
Yeah.
may be
Yeah, but
because
that
of
has got
that.
That was last
rectified.
year, and then they amended it afterwards,
Yeah.
the utility.
Yeah.
Initially, that
Yeah.
was the position, then they amended the
Correct.
utility.
In case of temples, bhandar, hundi, income is there which is anonymous. How such income would be taxed?
No.
See,
So
anonymous donation doesn't apply to religious trust, no?
Yes. So that's the answer for this. Donation to any person other than trust or institution registered under Section 12AB. If the trust gives donation to a trust who is not registered under 12AB, whether that amount needs to be disallowed.
So
that does not attract disallowance. It applies only to other registered trusts. Ashok, you agree with that?
So Act does not provide for this. If the particular unregistered trust has spent that amount, so in case of unregistered trust, your accountability to see that it is spent for the object of the trust becomes more this
You have to
thing.
prove that it is charitable also.
Charitable also.
It is charitable. Correct.
Charitable, and they are doing the activity, and that has been spent for the activity.
The
Otherwise,
onus is on you. Correct.
yes, the onus is on you, and the utility per se, the 10B and 10BB require it to be disallowed. So you as auditor, how you will not disallow it, something which you
You'll
need
have to
to
qualify. You'll have to qualify.
qualify.
Obviously.
Yeah, but that the trust has.
Yeah, it shows that other entities,
Yes.
correct.
Yeah, in Form 10B, would person specified under Section 33 and management can be same in cases where no specific dealings have been done by trust and management interested.
No, so the listing of management is there. So there is dealing or not dealing is something different. So that is 13.2 schedule is there. Whereas here you need to list the entire management which is operating and give their details. So that is a different. So there are two places. One is where you give the details of the management. The other place is the transactions are to be given in 10B. So there are different schedules for each of the items. So where you have not done any transaction, it will be nil, but you need to give the details of the management in any case.
Okay.
Sir, you want to add?
Yeah, I agree.
Is filing of 3 years ITRs compulsory for obtaining 12A or ATG certificate, provided that there is no taxable income? If yes, can we file updated return of a trust? So here I believe that trust is old trust, but since there was no income, they were not filing it.
Yeah, so there is no need. You need to give the accounts. There is no need to give the return of the trust. There is no need to file an updated return, because updated return can be filed only if there is any extra income. And if there is any extra income, you can file an updated return. Otherwise, just for the purpose of registration, you need not file a updated return. If there was no need to file return because of 139(4)(a) saying that maximum amount not chargeable to tax, then there is no need to file a return. You need not file a return, but give your accounts. That's all with the registration.
Yeah, and practical difficulty is that updated return doesn't get, you're not able to file it unless there is some additional tax payable. That's the whole problem practically.
Yes.
Yeah. Can we file form number 9A every year? Can form 9A and 10 be filed simultaneously?
Yes, I don't
Ashok?
see any difficulty.
Yeah. Okay.
Yeah, only problem is if you're not spending and you're just filing Form 10 and Form 9A, I think it's problematic when it comes up for renewal. They will say that, are you spending for charity or not?
And even in the return, when you give the details of all the 9A, because now it is online. So all the 9A forms or Form 10 filed will be looked at by in the return also. The table, if you have not spent it, automatically takes it into income and taxes you. So your 143(1) itself will bring that to tax if you have not done it now with the new system.
Okay, so I think there are still a lot of questions are there, and I don't know if should we end at this, or can we take for five minutes more?
We don't
Gautam and Ashok?
No,
Yeah,
I'm fine. I mean, we
I'm
can
also
take
fine. Let's complete the
Okay,
question.
fine. Yeah. Fine. So, is corpus donation received in financial year 23-24 lying unutilized in bank account taxable in financial year 23-24?
No, bank account is also a mode under 11.5. So there is no question of taxing it. You can mention that it is bank account is also mode specified in 11.5. You can have a balance lying in bank account is compliant with 11.5.
No, Ashok, only
Yeah.
one question is that today you are required to earmark corpus donations.
Yes.
Therefore, is that earmarking done or not? So does the entire bank account represent? If it is a consolidated bank account and is not separate for corpus, then I think you may have a bit of a problem.
I
But-
stand corrected to that extent. Yeah.
Yeah, but how do we earmark that donate even that FD?
In the balance
say,
sheet,
particular-
see, Deepak,
in the
you will
balance
show,
sheet only?
in
Yeah.
the balance sheet, you'll show earmark investments separately and
Okay.
a schedule of that, which fund, how much investments, etc. That's the way
Yeah.
you'll show it.
No. Sometimes the one view was earlier was there that in the bank FD you should go to the bank and read that this is earmarked FD or it is
Not
not necessary
necessary.
now.
If you do it in
Not
your account,
necessary.
that's good enough. But therefore, when
Okay,
you're
fine.
finalizing the accounts, you should take care that you earmark it.
This question you have answered already. Whether income tax paid is allowed as application of income? Yes. Amount paid to participants of Indian sport person for event out of India is application.
See, it is to encourage sports in India, you can say, when it's paid to an Indian sports person. And it's to encourage sports in India, and therefore the purpose is in India, is the way I would look at it.
Yeah. Okay. Yes, these presentations will be shared by email to all
And
the
Deepak, you have to answer
participants.
that question.
Yeah. That's why I said we will be sharing
we'll share it
yes.
with you. We'll share
Yeah,
our presentation with you.
yeah.
Yes.
In case of a trust where there is a disallowance under 115 BBI and also 1310, which rate will apply, MMR or 30%? I think this also has been answered.
Yeah.
Yeah. Are there any different rules for trust registered and operating in state of Goa?
There is no local trust law in Goa. So that's one thing. So unlike the Maharashtra Public Trust Act, which you have in Maharashtra, in Goa, there is no. Income Tax Act is obviously the same, whether you're in Maharashtra or in Goa.
Okay. If loan received from trustee, whether still charity commissioner permission is required to be taken?
Yes.
Yes.
Technically,
Any
yes.
loan taken by charitable trust, you need permission.
If trust has given donation to other trusts up to 85% of total income, then in those cases, trust will have taxable income as 15% is exhaust.
The question here is, if you have given a donation of 85, so you will get a deduction, application of income will be 85% of 85, which is 72.5. So, and you'll get the accumulation of 15 on your income of 100. So therefore, effectively, the difference will be taxable. That is the way it would work.
Yes.
And not straight away 15% as such.
No, not so 15, you will get 15% you will get plus 72.5 you'll get. So 87.5
Correct.
will be exempt. 12.5 will
Yeah.
become taxable there.
Correct.
If you have given a donation of 85 out of 100.
In case of a charitable trust primarily engaged in religious and social activities, the character of the trust does not specifically define trustees. As such, are all 100 odd members of the trust be deemed as trustees, or would be current 9 managing committee members be deemed as trustee of the trust?
See, for a society, it's a managing committee members would be regarded as this thing in a case of society. I think so. It is not all the members, persons who are managing, they would be regarded. See, there is a trustee and there is a manager also. So the persons who are management, I think it would be the persons who would have to be.
So a practical view is to put the name of the managing committee and put a note in 10B saying that the members list is kept, we have considered only the management committee. The members list is maintained separately.
Is it mandatory for trust to submit a financial budget with charity commissioner office every year? If so, what is the deadline and what is the penalty for non-compliance? Is condonation for delay available? Ashok?
So it is by end of February every year, 1 month before the financial year begins, you're supposed to submit the budget to charity commissioner. The penalty, I think, is a nominal amount. I don't think they levy penalty at all.
No, there's no penalty provided specifically for this. They don't levy any penalty for non-submission of this thing.
But auditor is required to comment
Yes.
in the Maharashtra Public Trust Act audit report that yes, budget has not been filed.
Budget has not been filed. Yeah. So audit report itself has a qualification. Yes, no.
Whether budget has been filed,
budget
correct or
filed
not.
on. Yeah.
Is donation received from building is corpus or voluntary donation?
Yes, if it is received for construction of a building by a trust, it will be a corpus because building itself is a capital account. So building fund, there are tribal decisions which have held that donations received for a building fund are corpus donations.
Our donations by trust can only be given to other trusts having similar objectives?
Yes, you
See,
can't give.
Yeah. So
Yeah, sorry.
yeah. So any donations which are given have to be meet with your within your objects. You cannot spend for anything which is not within your objects. So that trust, there have to be some common objects at least, and you have to give a donation for those common objects. That's the way it would work. Otherwise, it's a violation by the trustees. And if you spend for purposes other than the purpose of the trust, your registration can be cancelled. That's the problem.
Assessee failed to reply in time for renewal of provisional registration, and the application for registration was rejected. What are the options available?
You can reapply or you could go and appeal. You better is if you activities have started and there is a issue with regard to the funds during the mid period, you could actually go and appeal to the tribunal and say that there was miss out on submitting details. They'll set aside the order, submit the details again, and get the registration from the day one. Sir, you want to add something?
No, I think correct. Absolutely. Absolutely. It would depend on the facts whether you go and appeal or whether you reapply.
Yeah.
And with condonation of delay.
Can a trust make corpus donation of its own general corpus to other trusts having similar objects and also permitted in the trust deed?
Yeah, if it's permitted by the trustee, yes. See, there are two things which are required to be permitted by the trustee. One is that to spend the corpus first, the trust has to have the right to spend the corpus. If it has no right to spend the corpus, it cannot donate its part of its corpus. And second is the objects, of course, have to be similar. Ashok,
So
any?
What is?
Yeah, so in this case, he is he trying to say that my regular income I'll donate as corpus donation? That is disallowable. My regular
He's talking about donation from my corpus into the corpus of that trust.
Other,
yeah,
It's
other,
permissible because that in any case does not enter part of your computation.
not corpus at all. Yeah.
what is educational expenses as per BPT? It means donation to needy child for his or her
That
formal
we covered.
education.
We covered that.
Yeah,
When you were saying, we covered that.
Whether income up to 2.5 lakh to charitable trust. Okay, that also we have covered. Government grant not taxable, but SEC shown as voluntary contribution and return should be in Form 5 not being registered.
So, sir, do you would like to answer?
ITR.
No, which ITR to file? Whether ITR 5 or ITR 7
Yeah,
is
no. So if it is a government grant is received, the government grant per se, if whether it is a trust or not. So if it is a trust which is registered under 12, it has to file ITR 7. If it is not registered, then it can file Form 5. And whatever government grants are given, government grants per se are not exempt. So it is for specific purpose. So if you've used it for that specific purpose, whatever you spend is exempt, balance will be taxable in ITR 5. So you want to add something to that?
Yeah. So also, there is this controversy as to when you get a grant to be spent for a specific purpose. And if you don't spend for that purpose, if you have to refund that grant, the question is that grant taxable as income at all? Or is it something which, it's a liability until such time as you spend it? At that point of time, it's your income as well as your expenditure. And I think it depends on the facts of that case. So therefore, there is a case to say that, yes, if it's refundable, if you don't spend it, then it's a liability and not your income until such time as you spend it for that or refund it. Then in that point of time, it is not your income at all.
Ashok, this is utility problem. I think a question is, while preparing computation, 15% accumulation should be taken of total income. However, in software such as Winman and the accumulation calculated on total income minus donation given to charitable trust. So which one is correct?
If you take the utility, it will take the total. So if you look at the circular, like sir has already covered this, when you are giving donation to some other trust, on that 85% is allowed. So 15% which is not allowed cannot be accumulated because you don't have it. So why would they allow you to take 15% of that? So to that extent, it is correct, na?
No, Ashok, that circular, they allow you to take 15% of your income.
Yeah.
So So long as you're within your 15% overall of your income, it's allowed. In that sense, they're saying that it is not that this will be amount will become taxable altogether, is what they've clarified in the circular.
Yeah, but sir, if you look at the working is very difficult. So if you look at Winmans, they are not allowing it, sir, as of today.
No, that's not correct. I don't think that's correct. Because see, the whole
Yeah, that
in
is
fact,
his question.
representation was made that you should allow so long as I have within my 15% accumulation, yes, you should allow that, and that's what they've said. They've clarified that even if that money is not invested, it will still be allowed to you as because that is not with you. In fact, that's specifically that line they said that since the funds are not with you,
Yeah.
you can't accumulate. But then this is
But
no,
as of now, the utility is not allowing it, sir.
it's not
So
allowed.
we'll have to.
Yeah, that will have to be, I think,
Leave with it,
represented.
yeah.
Deepak, maybe on this utility, maybe the BCA should quickly make a representation on this. The
Okay.
earlier point also, this point also,
Yeah,
maybe if
sure.
it's not permitting, we need to draw the attention to this.
Yeah. Trust received 9 crore fund for CSR project, 1 crore general donation. So total income is 10 crore. Accumulation of income 15% is on only donation of 1 crore or 10 crore total income.
Sorry, 9 crore is what?
9 crore is CSR project fund
Uh,
and 1 crore general donation. So 15% would be on 10 crore or 1 crore. Because it is 9 crore is for CSR.
the CSR also, the question is today, if you don't spend it, is there an obligation to refund? And that's where the question arises. See, there are two schools of thought in this. When you have a tied up grant, like a CSR donation which you receive, where there is an obligation to refund. So is it a conditional donation or is it something where there is an obligation to refund that amount, unspent amount, and therefore is it a liability? That's the thing. So there have been Rajasthan High Court decisions and Hyderabad tribunal decision, which have taken the view that in such cases, it is not income until such time as it is spent, because there's a liability, there's an obligation to refund the amount. In that situation, it's only at the point of time of spending that it will be treated as income, and therefore your 15% will be allowed. If you take a view that no, it's a conditional donation and therefore part of income, which there is a Bombay High Court decision which has taken that view. In that situation, then you would get 15% accumulation over that. So there is a controversy on that. I think we've covered it in BCA Journal also in the controversy column.
Yeah. Ashok, this question, books of accounts are maintained on cloud-based software and hosting service provider is located in a different state. Will it be considered as maintained at page different from registered office?
So cloud-based, so generally what we do is for registered address, we keep a backup of that, this thing, because ultimately you need to maintain the, that cloud is generally outside India. So as per the data rules also, you're supposed to maintain a copy in India. So therefore we tell them to maintain one backup download in the registered office. In that case, you need not mention that the accounts are maintained at different places and file it with the with the assessing officer. Sir, any different view?
Ashok, Ashok, also, is it, the fact that it is accessible from the registered office would mean that it's maintained at the registered office is the way I would put it. It doesn't really matter.
Yes.
System don't allow to file new 9A in case original, I don't know, question is.
No, so that is with regard to that 9A, second 9A is not allowed to be filed. Till last year, we have filed one second.
Yeah.
And, so now they might have stopped it. But till last year, we have filed one additional 9A in 23 and written to the assessing officer for it. I'll have to check whether you can file it, the revised one now.
I think it's for the current budget. Sincere thanks, Gautam sir. One clarification, if you can throw light. In the current budget, Honorable FM has made change under section 47, whereby only gift from individual HUF is not regarded as transfer. And question is, what would be implication if charitable trust donates property to another charitable trust? Can plea be taken that? Sorry?
Deepak, there's no problem there because Bombay High Court in Shatavan Bhagavai Maffatlal Trust case 247 ITR 1 has held that the status of a charitable trust is individual. So therefore, the donation is exempt under 47 so far as the charitable trust is concerned.
Okay. Interest accrued on corpus, whether to spend for qualifying exemption or will it be okay if it is further invested along with corpus investment? I think
See, I think this is a reference to that Supreme Court decision in the case of Amritananda, my trust, where so the donor had specified that not only the initial corpus, but the interest also on that corpus should be held as corpus, is this thing, which was the stipulation. And there the Supreme Court held that, yes, it is a corpus and therefore not income. But I think, frankly speaking, the income on the corpus would not be corpus itself. It would be income which you are required to spend 85% is the way I would. So otherwise, to get that sort of this thing, you might have to go all the way up to Supreme Court.
in TDS refund, both Indian and FC gets mixed. FCRA law says that both sources cannot be mixed. What the solution? Also, which account be used to receive refund, Indian or FC?
So I think this is out of the syllabus question because this is on
Okay.
FCRA Act. We can have a separate session on FCRA Act. Maybe you could keep this question there.
Yeah.
So which
are you supposed to apply entire accumulation under 11.2 only for the specified objectives as per Form 10, even in case of dissolution?
see, you can donate to another trust, but yes, it has to be for those objects.
No, sir, 11.5. Accumulation of 11.5 will have to be spent, otherwise it will be disallowed.
No, 11.2.
11.2.
The point was
11.2.
11.2 accumulation in a situation where the trust is getting dissolved. So, and there is specific provision whereby it can donate it to another trust, which is permissible, which otherwise is not permissible. When the trust is being in the process of dissolution, there is specific provision for that. And but it has to be, that donation has to be for those purposes only. You should specify, saying that I'm donating to that trust for the purpose of this particular purposes. So it should be for those purposes.
Can interest earned from corpus fund deposits be treated as corpus donation?
We discussed that just now. No?
Yeah.
Yes.
Honorarium to trustees is applicable or payment to specified person, and hence no no application and taxable.
No, so honorarium to, if it is reasonable and it is at arm's length, it is an application of funds. Only if it is excessive, then it is to be disallowed.
Only thing is that the trust deed should permit that. Because normally trustees are supposed to do honorary services to the trust. So the trust deed has to have this provision that, to provide honorarium to trustees. It's only then that can be paid. That's something which we need to keep in mind. Otherwise, there's a violation of the Maharashtra Public Trust Act.
Yeah.
Can we revise Form 10 and increase the accumulation amount?
I'll have to check whether the system, because you just had a query that Form 9 cannot be revised in this current year. So till last year it was allowing revised Form 10. This year I don't know whether it is allowed. I've not tried it as of now.
Yeah, till last year it was being allowed, I think.
Allowed.
Correct.
Then this is, I think, question common. Why saving bank account is not permitted to charitable trust and only current account should be held in as a bank account? Why that new column they have started, no current or this?
So there's a RBI circular on this, and RBI has stipulated this. It's not the thing or anything to do with the Public Trust Act or the Income Tax Act. It's a RBI stipulation that the types of entities which are permitted savings accounts, the RBI has specifically laid down. That's
But they are not closing the existing saving accounts to current accounts. So if you are holding an existing saving account in a charitable trust, they allow you to hold it further. Only the new saving accounts are not being opened. Only current accounts are being opened.
No, so the question is in that written form, whether should be write as other bank account or current account, though it is saving in reality.
No, you write savings account. No, what is the harm? There is
it is not allowed. That saving option is only not available.
Then you'll have to put others. Sorry, I missed out on that. Then you'll have to put others. Sorry.
Okay, fine. Yeah. Whether donations can be made to other trusts from accumulation made under 9A and 10.
I've covered that.
I think we answered. Yeah.
You covered.
Last question will take amount accumulated under 11.2 up to March 22 to be used in 5th year or 6th year?
5th year.
Up to March 22.
Yes, 5th year.
5th year. Yeah.
So there, Deepak, I think people are trying to take the view that it applies to accumulations after that date. But if you look at the amendment is also in 11.3. So 11.3 is applies in the year in which that fifth year expires, and that's where the problem would be.
So in this, there is an issue where 17-18 was
Yeah,
getting.
I know. So that I'm aware of that the thing.
Yeah.
We had a discussion also with Devan on this.
Yeah.
So we've so question there is really is that I mean the view can be taken that it's not taxable at all. Is the view which I said, but it's something which one have to.
Yes.
The accumulation up to March 17, 5 years. So that in 22, the law was that it would be taxable in the 6th year. In 23, when you go, it is taxable in the 5th year.
Yeah.
So is it taxable at all and in which year? That's the question.